Every Canadian investor eventually wonders, should I add real estate to my portfolio? Well, owning rental properties sounds very appealing, but it comes with tenants, maintenance, and, trust me, endless headaches. That's where REITs, real estate investment trusts, come in. And if you want to own a basket of them, in one simple trade, you should look at XRE, the iShares S&P/TSX Cap REIT Index ETF. XRE has been around since around about 2002, giving investors exposure to Canada's biggest REITs. It's one of the oldest and most recognized real estate ETFs in the country. But here's a question. With interest rates essentially shaping the market, is XRE still worth holding? Or has the Canadian REIT sector lost its shine? Let's take a look. Real estate has always been one of the oldest wealth-building tools. REITs lets you own pieces of towers, shopping malls, apartments, and industrial warehouses, all without buying property yourself. They trade just like stocks, they pay monthly income a lot of the time, and they give you diversification across the real estate sector. These days, Canadian REITs are very attractive because they offer high dividend yields, which are often above 5%, and steady cash flow. That's especially appealing in a world where investors crave a little bit more income and stability. But REITs are also sensitive to interest rates. Rising rates increase borrowing costs and can pressure valuations. Falling rates, on the other hand, make REITs shine. So the big question isn't, do you want real estate exposure? It's more like, can you handle the ups and downs that come with interest rate cycles, which absolutely happen in Canada. But let's look at XRE. XRE tracks the S&P 500 TSX Cap REIT Index, holding around 19 Canadian REITs. That means you're instantly diversified across retail, residential, office, and industrial properties, which makes it a little bit easier. Inside XRE, you'll find names like RioCan, SmartCentres, Canadian Apartment Properties REIT, and Allied Properties. These are companies that own the malls you shop at, the apartments you rent, and the office towers that shape Canadian skylines. The ETF has about $1.07 billion in assets and charges a 0.6% expense ratio. So it's not necessarily super cheap, but it does pay monthly distribution yield with around 5.3%. That monthly payout is one of the biggest selling points. For income investors, it feels like a paycheck from real estate, without the hassle of actually being a landlord. Let's see why the investors are often flocking to XRE. I would say the reason is XRE is very simple. It gives you exposure to Canada's real estate sector. It pays monthly income, which is perfect for dividend investors. And I would say it's pretty diversified. You're not betting on one property or one REIT, but on the entire sector. For investors who want real estate exposure without becoming landlords, I would say XRE is one of the easiest solutions. It's quite liquid, it's transparent, and is backed by some of the largest property owners in the country. Of course, there's another upside, which is interestingly psychological. Real estate feels tangible. When you own XRE, you know you're indirectly invested in apartments, malls, and office towers you see every single day. And that makes it a little bit easier for some investors to stay committed, compared to abstract holdings like tech stocks or bonds. However, everything's got its own downside. REITs aren't risk-free. XRE is highly sensitive to interest rates. When borrowing costs rise, REITs struggle. When rates fall, they usually rally. That makes timing very tricky. It's also concentrated in Canada. You're exposed solely to Canadian property markets only, with no international diversification. If Canada's economy slows and people don't buy houses anymore, your REIT exposure slows with it. And while the yield is attractive, the ETF's long-term growth has lagged in comparison to equities. Over the past year, XRE returned about 3.4%, way below the S&P 500. And that's the trade-off. Income versus growth. Another challenge is sector concentration. Retail REITs like RioCan and SmartCentres make up a large portion of the fund. That means you're very heavily exposed to shopping malls and retail properties, sectors that often face the long-term pressure from e-commerce. But let's create a hypothetical example here. Imagine two investors. Sarah buys XRE for her TFSA. Daniel instead sticks with only equities portfolio. Over the years, Sarah collects monthly distributions that are quite steady and predictable. Daniel, on the other hand, enjoys higher growth, but no income. And this is a trade-off here. XRE is about cash flow and diversification, and equities are about growth. Sarah feels very reassured by her monthly payouts, while Daniel rides the ups and downs of the stock market. And look, neither is wrong. It depends on what you value more, and that's always the decision that you have to make. steady income or maximum growth. But of course, this hypothetical example is great, but let's look at the numbers. Over the past year, XRE delivered a fairly modest return of around 3.4%, as I mentioned. And over the 3 years, the annualized returns was closer to 6%. Over 5 years, it averaged about 4% annually. So, of course, it's not anything spectacular compared to equities. But remember, the yield here is the main attraction, not the growth. With a payout around 5.3%, XRE is designed for income investors. It's less about capital appreciation and more about steady distributions, which some people love. Now, how does XRE compare to other REIT options? Well, you could buy individual REITs like RioCan or Canadian apartment properties, but then you're betting on one company. XRE spreads the risk across 19 names. You could buy XRE, the BMO equal weight REITs ETF, which gives equal weight to each REIT instead of capping exposure. That's a different strategy, but it comes with slightly higher fees. And maybe we'll talk about them in one video coming up. You could also look at global REIT ETFs, which give you exposure to the US and international property markets. Those offer a lot more diversification, but they don't give you the same Canadian focus. So it just depends on what you believe in. XRE's advantage is its simplicity. It's the oldest, I would say most recognized Canadian REIT ETF, and it's incredibly easy to trade. So who should choose XRE? I would say XRE is ideal for investors who want real estate exposure without owning property, those who value monthly income, and are comfortable with slower growth compared to equities. It's for people who want diversification within Canada's property market and who see REITs as a hedge against inflation and a source of cash flow. I would say it's not for investors chasing maximum returns. And it's not for people who want global diversification. Lastly, I would say it's not for those who panic when interest rates rise and your ETF is trending down. To summarize, XRE remains one of the simplest ways to invest in Canadian REITs. It offers a monthly income, diversification, and exposure to Canada's property market. But it comes with risks: interest rate sensitivity, sector concentration, and slower growth compared to equities. If you want income and real estate exposure without owning a property, I would say XRE is still a solid choice. If you want maximum growth, you may prefer equities or global REIT ETFs. The real question isn't whether REITs are good or bad. That's not the question at all. It's whether they're a good fit for you and your goals. If monthly income helps you stay invested or motivated, XRE is worth it. If you're chasing growth, you may want to look somewhere else. Anyways, guys, once again, thank you for watching. I really appreciate it. If you found this breakdown helpful, like the video, hit the subscribe button. It tells YouTube that this video isn't totally useless and there's a little bit of information in it. And honestly, that's all I'm hoping for. So thank you. And remember, this is not a financial advice. I'm here to give you information, not tell you what to buy. Although I do give you my opinions. Anyways, thank you for watching. I really appreciate it. Take care, and I'll see you in the next one.